ado, I do want to pass it off to a good friend of mine over at Schaeffer's, Matthew Timpane. He's going to be taking us through a little bit of market education. So if you want to, we're learning about the tools today. He's going to be talking about the market itself. Matthew, I'm going to pass it your way, sir.
All right, wonderful. Thanks, Luke. As you mentioned, my name is Matthew Timpane. I'm a senior market strategist over at Schaeffer's Investment Research. We've been in business now for 40 years, providing option trade recommendations, news insights, and free education to retail traders. I was previously a portfolio manager and a partner at a registered investment advisory firm, handling multi-asset portfolios, and I moved my way over to Schaeffer's to really challenge myself in the options market and to dive extremely deep into this area. Like so many other retail traders now in the area, I'm here really, I wanted to be able to help them and be able to provide them with insights that they might not know yet, because we have the time. This is what we do every single day. So without further ado, we're going to kind of just quickly go through this presentation here. And if you have any questions, feel free to throw them in the chat. First off, we're going to look at a macro backdrop here kind of quickly, and then go into some sentiment and seasonality. And then I'm going to kind of just share some screens, kind of how we do it, how we're a little bit different than some other places. And then I'll throw out some trade ideas that could be coming up. Currently, typically I'd rather put trade ideas that are potential for the future than that have already happened, because the idea is for you to make money as well, so you can watch these levels, see if they hit. So just to kind of pop this out to begin with, we have the NASDAQ 100 ETF QQQ Trust. It's kind of been trading along this whole price channel throughout 2021 since last year, really. But what really kind of spoke to me recently was we did kind of see it hit resistance level around 400. That is the peak call level for open interest, right on the dot. So, there's a reason why we're starting to pull back here currently, as we've had this massive rally. Now, I'm not too bearish, as we have seasonal tailwinds at our backside. I've been talking about this at previous conferences and through Twitter, so you can go back and look. But I'd really be more looking at this for a dip buying opportunity if we do get a pullback, maybe down to around the 380, 370 range. These are, where two large put strike open interest levels are sitting, and they could act as support. Now, 350 is the peak put currently, which I don't really see us getting all the way there, but things could always change as markets develop. But as of right now, that's not an area I would look for, since we do have these seasonal tailwinds in Q4 and heading into the new year. I would really kind of look for maybe more of a mid pullback to that 370, 380 range to get a buying opportunity. Now, I'm not saying that we can't continue to melt up here like markets have. I'm just saying it's probably more prudent to take some of your profits off the table right now and let some of your winners still run until you can see a bona fide breakdown in those securities. Now, I also placed on here a 125-day moving average, which has acted extremely similar to 2014 through 2016 market cycles. So I haven't really seen this do this since then, where major indexes were finding long-term supports around those 125-day moving averages. So it's kind of unique to see that coming back into the markets again. So that would kind of be like an ultimate dip buying opportunity here on the Qs going forward. It's also near that lower end of that price channel, and it's something you want to continue to bet on as long as we don't break down. Now, I always like to kind of zoom out, when, looking at securities, because you're able to identify some levels that you might not have noticed before. And then in this particular case, I really wanted to kind of show how the securities or the QQQ specifically act around these round century level numbers like 300 and 200. As you can see around the $200 level, we kind of started getting some hesitation a little bit prior to it. And then, for about a year, it took to consolidate around that $200 level between 190 and 200, kind of it kept peaking out as resistance. So it took some time. That's could be what happens here again. Now, when we did get to the $300 level, it only took about 6 months to work through that, but it was volatile, and we had some great opportunities, long and short, during those 6 months. And we're probably entering a similar situation right now. Not to say that we can't just break up and move on out and up from 400, but typically it does have a tendency that it's going to want to consolidate a little bit of these gains, let the market kind of rest a little bit. But you're still going to find good opportunities. So it's nothing to be scared about or anything like that. It's something to look at as an opportunity. Now, I did leave the 125-week moving average on this chart, just kind of carried it over from the daily. And honestly, I was amazed myself. It has marked long-term bottoms since 2015 in the QQQs. So it's something that I'm going to keep on my radar and have set an alert for when you're looking really kind of how I said, you'll see support and resistance areas that you don't necessarily see, even when trading options, when you pull out to the weekly and monthly charts. So it's something, if we did for some reason ever get a move back down there, even though those daily charts and those intraday charts may look like, just horrible, you might want to be able to, place a few of more speculative bets at that time because you can really kind of see some upside. Now, why we have been bullish was strictly because the case within the small caps. We talked about this at the small cap conference. So, just quickly touching on this quick here, we saw that the Russell was kind of going through that typical year two bull market kind of consolidation phase where the S&P 500 and the NASDAQ wasn't. But what the small caps were doing was they were consistently finding support at the 200-day moving average. And in past cycles, it's either been the 200-day moving average or the 320-day moving average have been the optimal buying opportunities for small caps. And oddly enough, that 210 to 212 area down there, which was support, was also 10% year to date. And then 232 level, which was kind of resistance throughout the year, was plus 20% year to date level. Now, what got us extremely bullish was when the divergence finally ended in relative strength. It kind of broke out. We knew that we were probably going to break out to the upside. So now what we would like to see is probably a nice pullback to test that breakout level, but we would like to see small caps continue on in the rally, continuing going forward. This is the growth versus value relative ratio chart. I think it's important to know so that you know where to allocate your funds to. Right now, growth has actually kept going. So as much as people had concerns about interest rate rises, growth has still been outperforming. Now, it went through a consolidation phase throughout the year as value did have its moments this past year, but growth is back again in the driver's seat, and it now has broken out from those late 2020 highs. The one thing about it is I think people are getting over panicked about the interest rate rises. We are coming off a really relative low basis of interest rates. And as long as the Fed doesn't do anything crazy by upping interest rates by a full point to curb inflation, I think growth can still handle quarter point raises in interest rates when those happen possibly here in 2022. So it's not something that should be scaring you away from the growth opportunities. You should be looking at them as buying opportunities because people will panic sell a little bit even on a quarter point raise. And it should be just looking to allocate to those stocks that you want to keep going and holding in your portfolio long term that have high growth outlooks. Another ratio that I like to use is the high beta versus low volatility. It broke out of this huge 10-year range. We highlighted this last year, but where did it peak out? That's kind of where it kind of stalled out for, during 2021. Now we're back above those highs. So if we are going to continue to have a melt up in the market, I would expect this high beta versus low volatility ratio to hold those that recent breakout. If it doesn't, that can mean that we're going to have like a little bit of a pullback. Could just be 5-10%, but it's be a nice little indicator to know where we're probably going within the next couple weeks to a month. Now we're at a fintech conference, so we should probably show something to a fintech industry or sector standpoint. So I have pulled out two ETFs that best encompass the sector in itself. We have the ARK Fintech Innovation ETF, and while it's not the perfect proxy for fintech in general, because obviously Kathy Woods makes her selections, but it's a decent proxy for what we have. Currently, it's sitting just kind of below that 10% year-to-date level. It is above the year-to-date anchored VWAP level, but it is still below that peak anchored VWAP level. So it's kind of just coiling right here while it's been holding this trend line throughout the year. So, there's obviously a chance that we can come back down test that year-to-date break-even level and that lower trend line. But what we would like to look for a bullish activity, specifically in fintech, is a breakout above that plus 10% year-to-date level. And if you're more conservative, you might want to look for a breakout above that 361.8% Fibonacci extension level that came from the pre-pandemic highs to the March 2020 lows. That would be around $56, and that would kind of give you a nice conservative and definitive buy signal for the ARK Fintech Innovation ETF. Probably a little bit better of a proxy would be the Global X Fintech ETF, FINX. It's a little bit more diversified, still probably not the perfect kind of industry ETF for fintech in general. I think a lot of things are probably left out, but it kind of gives us a better idea. It found support recently at year-to-date break-even. You kind of have this, inverted head and shoulders pattern that it kind of broke out from, came back to test those previous highs, and now we're kind of sitting here just above 10% year-to-date level, right at those highs. So if we break out above 53, it's probably bullish for the whole sector among fintech. It's kind of, certain areas have been struggling, certain areas have been extremely hot in the sector. This could kind of broaden the base a little bit if we see this breakout. So since we're an options firm, wanted to kind of just touch on this. Last Friday was actually the second largest volume day in terms of total option volume, with over 57 million contracts traded. Equity volume also set a record that day. But equity put volume was pretty low. So we're seeing a little bit of aggressive call optimism within the market in itself. The previous market high in this, and I do see the line was kind of cut off a little bit here, but the previous market high was in January 27th, 2021, where we traded over 60 million contracts trading hands that day. But what does this tell me? This tells me a lot of the retail investors that came in during the pandemic shutdowns haven't left, or the ones that have left maybe blew out some accounts, but the ones that have stayed have maybe grown their accounts and they're buying more now. So I think this is really encouraging to the do-it-yourself investors, for the people that are going to be using fintech products, trading themselves, instead of using advisors. Nothing wrong with using advisors, but I do think that there is a shift to a lot more investors doing it themselves, and it's totally able to be done. All you got to do is take the opportunity to learn the markets, and you can really do it yourself. This is one of the biggest reasons why I joined Schaeffer's Investment Research, was to help the retail investors just do it themselves. So another thing that we kind of do that's maybe a little bit different than other places is we look at put call volume ratios in unique ways. The NASDAQ 100 components is for the buy to open put call volume ratio. So what we're doing is we're actually looking at the components, not the index itself. They are coming off a 7-year low where they ripped up to a 17th month high, and now they have obviously come back. They closed yesterday around 0.433. This has been a great indicator of marking short-term tops and bottoms. And what we really look for is we look for inflection points. So yes, we might be starting to round out right now, but we haven't seen an uptick yet. So that's why I haven't, looked at it as, we're in a bearish predicament just yet. We could continue to see a melt up here. It might not be over with because we haven't seen this uptick yet in the put call volume ratio. This is something that you can find quite often on our site through our Monday morning outlook, or sometimes even in our indicator of the week, which I'll actually probably talk about here in a little bit. But you can always go there. We're always putting this out, or I'm putting it out on Twitter, or our Schaeffer's company is putting it out on Twitter as well. So, take a look out there. We're always trying to provide some insights to the retail traders. Like I said, we do some things that are unique. So we take basically a FANG ETF version of, or a FANG put call volume ratio of the FANG securities here. So we see that the combined ratio tumbled recently to 0.367 after yesterday's close. It's well off of its recent peak, but it still has lower it could push if the market wants to continue higher. But we are getting down towards the lower end of those ranges. So that's why we're a little bit more cautious here. And then finally, we created this meme index put call volume ratio with about 20 different securities, and it's got things like AMC, GameStop, Palantir, Robinhood, etc. in this. There is a lot of call bias in these meme names right now. But what really kind of stood out to me about this was I thought this was going to be the best indicator for marking tops and bottoms. And it tells me that it really isn't. What it is it's encouraging. This ratio doesn't really mark those tops and bottoms well. And it tells me that these long premium buyers are more sophisticated than past retail generations. So we can see here that, they've actually had huge put volume near market tops and more call volume near market bottoms at times. It's about 50-50 right now, but to me, that's extremely encouraging for the retail investor that, they're not always on the losing end of the trades here against institutions anymore. On to seasonality. This came out last week in our indicator of the week that our quantitative analyst, Rocky White writes every week. And I thought it was interesting to follow up on some of the seasonality stuff I've been putting out there for the past month and a half, because it's really showing you what happens to the S&P 500 when it's up 20% through October. As you can see, it's not really a condition for an overbought market. It's actually a condition that says, Q4 is going to be probably better than typical years. As, we had 8 returns previously before the 9th year being put in this year with 20%. So of those 8 years, the average return was 6.23%. Now that's against every other year, which averaged 2.84% since 1950. So that's, a solid 3.5% difference between the other years and this type of year. So we still have these positive seasonal tailwinds, even though November's already been super great. We're going to want to continue to look for buying opportunities as we continue to head into year end. So using a least squares method, what we wanted to do here was we wanted to look at the last 10 years of the most familiar chart path. That way you're not just getting things of 20% or better. We're trying to look at something that is very similar to the trajectory that we've been on this past year. And again, this came from the indicator of the week. And the most similar year was 2013, and that went on to gain 5.13%. But as you can see, the average gain is 4.13%, and that beats the average return of all other years since 1950, which is 3.08%. Excuse me. I'm battling a little bit of a cold, so I'm going to put a cough drop in. So even though it's not extreme, it's still 1% better than previous years. This is fourth quarter by seasonality, and we kind of broke it down into industries. I've showed this at previous conferences, so I'm not going to touch on it too much. Sectors and industries that still stand out to me are industrials and financials. Financials haven't actually had their seasonal drift that they typically do in November. They've actually been negative on the month, whereas they're usually fairly positive. So those are areas I would probably stick with. Tech still does well through fourth quarter. But the big thing that stood out to me was alternative energy. And, we've seen massive rallies in that. Now, that is at the bottom of the list because the percent positive is the lowest. But when it does rally, it rallies harder than anything else. So we actually had one of those years where alternative energy is just skyrocketing in the fourth quarter, even though it's typically not the greatest quarter for it. So how do we do this? Well, we do a few different things here. We have moving averages that we quantify, and we look for significance within the last 3 years. But then since we compile all the option data, what we're looking to do is how is this going to affect the past call and put returns? So we're able to mark what moving averages have provided some significance, and then we're able to go back and look at those returns so that we can quantify this and give us an edge. This also kind of tells us what might not be a good buying opportunity too. So even though the chart may look really good, if we're seeing something like, MetLife Insurance here, where the expected call return is minus 79% in 10 days and minus 100%, we might not want to take that opportunity on a call trade. Now, MetLife probably isn't a a trade that we're going to take because it's not usually as volatile, but it's a good example. Another good example is Boeing. Just from the other day, yesterday, I believe Boeing was trading around 227 and failed. Now it's down around 221. Well, what was our bearish filter saying on yesterday's screen? It was saying once Boeing reaches that 120-day moving average, it has a tendency to fail there. And then the expected put return was 180% on a 10-day and 295% on a 21-day. Now, you're not going to get that necessarily, but we have the odds in our favor, which we feel that gives us a little bit of an edge unless things are fundamentally changing the characteristic of the stock. We can understand it a little bit better than a lot of people out there. This is probably one of my favorite screens. Stocks trading near their last significant call strike or near their peak call strike. And the reason for this is peak levels can be resistance. And then if you break through those peak levels, you can have those gamma squeezes where you get those plus 10% moves in the stock, plus 20% moves in the stock, and the thing just keeps squeezing. So that's exactly kind of how we use it. One thing that we kind of, one security that I noticed on here was HUT. You can kind of see, I believe that did break through its strike price yesterday, and that's why you kind of see it continue to squeeze. We might be seeing it pull back today, I believe, when I was looking at it earlier. But these are the types of things that we look at that are a little bit different. So we're constantly trying to find things that are trading near these levels so that we can play puts, or if they break out and break through them, we can get in on that squeeze. Conversely, you can use that for put strikes as well as support or as a potential delta hedge sell opportunity. This is where you get those flushes. So if you do break through that peak put support level, we often get those flushes where you can see a 10, 20% move very quickly to the downside. This is something relatively new that we just started doing over at Schaeffer's. We've always looked at 10-day buy to open ratios and the call volume and 50 days, but we've quantified the data now on how it's acting when they're within a certain percentile basis and meet certain other objectives. So this is actually something that has piqued my interest. I was looking at it earlier today, Redfin. It is, and I almost put it on here for a trade idea, but, it's sitting in its 96th percentile currently. But what does it do when it's in its 90th percentile over the past year? It's actually outperformed, and it's on average risen by 17.83% for the stock. So that's a candidate for a long call option in our eyes. And then we also do it with the 50-day. 50-day might be when we're looking at it not from a short-term standpoint, but from a little bit longer-term standpoint, making a call option. And then we also do this with call puts as well. So conversely, we can do this with call puts and then look for downside potential candidates that we can, long some put strikes on. Another thing that we kind of like to use is the low IV high price here. What we're looking for is things that are trading near their 52-week high that have relatively low implied volatilities. And then we're looking for the signals. So we're seeing how many times has this signaled in the past. We're not seeing this, you're not going to get signals of like 20, 30 returns because we're only looking for like recent signals. But, once you get past 3 to 4, you got some solid signals here on how this momentum keeps carrying the stock prices. So these are the types of things that we're constantly looking for. And then we also combine it with our volatility scorecard here, which I'm going to talk about next. Volatility scorecard is something that we've shown here plenty of times at Benzinga. We update this weekly right on our website. You can go to I believe, Market News and go in there and Volatility Scorecard. It's going to give you the top volatility scorecards that we publish each week on Monday. Really, I'm not going to go into this too deep because it can get a little bit complex, but in simple terms, it tells us how often a security of those underlying options have historically had underpriced or overpriced options based on their ranking. And then we rank them against all other securities as well within that optional universe. We show typically from level 100 down to about 80. But if the list is too long, I think like this week, the volatility scorecard took tickers from 100 down to about 95. But so feel free to go out there, check them out weekly. They usually provide you some good option trading ideas. So on to the trade ideas. We have 3 of them here for you today. Square has recently had, not the greatest earnings reaction. It's, trading lower in sympathy with PayPal as well. But there is a chance that we could be approaching an area where it's tradable. We're approaching this lower trend line in a symmetrical triangle. It's kind of almost even flaggish if you kind of look at it from this lower point down here. Year-to-date break-even is around 221. So this area could easily hold. What we could see is possibly maybe a breakdown and then a quick snapback, or we could just maybe hold this area. So it's something I'd be looking for. The volatility scorecard on this is 71. Options are priced in the 21st percentile, and the buy to open 50-day put call volume ratio is in the 84th percentile, with short interest percentage of float at 8.41% and rolling over from year-to-date highs. So there is some negative sentiment building up in Square, and that usually is what we're looking for to produce the most bang for a buck on call options. Also, the second largest put open interest is at this 220 strike level. So peak call and peak put are alternatively right now at 250 strikes. So you might have some upside gains capped. But if you did get this pushed down to that 220 level, it's probably worth the gamble to take a shot on this on the long side. Palantir Technologies just reported today is not trading very well, but it could be a short-term put strategy here down to some of these levels. You could have year-to-date if this breaks down right here, year-to-date break even. You could target on a short-term basis, or even coming down here to this $21 level, which is minus 10%. But in the longer term, I'm definitely more bullish on this. So I'd watch out for the fake out. Currently it's oversaturated in calls, which is the reason why we're probably getting a really adverse reaction here as well. But, oddly enough, where did it stop at today? It stopped at its IPO anchored VWAP position.
And hey, Matthew, I'm getting word that we're going to have to wrap up, unfortunately.
Oh, that's good.
I was ready for this one too. Palantir is a stock that I like. I haven't been in it for a while, but unfortunately, I'm getting word from producer Rohan that we got to keep moving.
Nope, no problem.
What's up with producer Rohan? I don't get it. Okay.
Yeah. See, now I guess we're just gonna have to go to your site to figure out what happens with Palantir.
What site? What's the site?
Will you give us the site? You got
Schaeffer's
Schaeffer'sResearch.com.
Yep, exactly. See, that's a gratuitous plug is what we call it in the media space, Matthew. So thank you very much for coming on and explaining what you guys do at Schaeffer's.
Thank you.
How many years has Schaeffer's been around for?
Schaeffer's been around for 40 years now. We've celebrated.
Holy moly. 40-year ding. Give me the 40-year ding, Rohan. Thank you. All right. Have a good day, Matthew. Thanks for coming on. We do appreciate it.
Have a good one, guys.
You too, buddy.